All right, let's talk Adobe. They just dropped their latest earnings, and honestly, the numbers looked fantastic. A solid beat pretty much across the board. But then, the market reaction was, well, a big nothing burger. The stock barely moved. So what gives? That's what we're going to unpack today, this strange disconnect between what Adobe is doing and what Wall Street thinks about it.
So here's the game plan. We'll start with the results, the good-looking numbers. Then we'll get into the AI growth story they're pushing hard. We'll look at their guidance and some big strategic moves they're making, and that'll bring us to the million-dollar question. Why the big shrug from investors? Finally, we'll give you our take with our rating for the next call.
Okay, first up, the results. And, looking at the headline numbers, Adobe really delivered a clean beat.
So let's kick things off with earnings per share. Adobe came in at $5.50. The street was looking for something like $5.39. So yeah, a comfortable beat right out of the gate. A really solid start.
And it wasn't just the bottom line. The top line, revenue, looked great too. They brought in $6.19 billion, when the consensus was only expecting around $6.11 billion. Another clean beat.
But, for me, this is where it gets really interesting. Forget the headline beats for a second. Look at the cash flow. A record $3.16 billion in operating cash flow just for the quarter. That is a massive number, and it tells you that underneath everything, this is an incredibly healthy cash-generating machine of a business.
So let's just put a bow on this part. We've got a beat on earnings, a beat on revenue, and their core digital media segment, the Creative Cloud, all that stuff, grew a healthy 11%. I mean, by any traditional measure, this was a fantastic quarter, which, again, makes that flat stock price so weird.
So you'd think the earnings call would be all about celebrating these numbers, right? Well, not exactly. The real focus wasn't on the quarter they just finished, it was all about the future. Management was on a mission to hammer home one single point: AI. AI is the engine now.
And the CEO, Shantanu Narayen, he was very direct about it. He flat out called fiscal 2025 an outstanding year and pinned that success squarely on the accelerating adoption of their AI stuff.
And look, they came prepared with the stats to back it up. Get this. Consumption of their generative AI credits, it tripled. Quarter over quarter, tripled. First-time subscriptions for Firefly, their AI image tool, doubled. And they're pulling in a whole new crowd. They've got over 70 million people using their free AI offerings every single month. That's a huge funnel. Now, a really key part of their enterprise strategy is something called Firefly Foundry. So what is it? It basically lets big companies, the giant global brands, create their own custom AI models. They can train them on their own private data, their own brand style guides, all of it. It's like giving a company its own personal, secure, on-brand AI. This is a huge and potentially very high-margin business for them.
And management shared this one killer anecdote on the call. They have this one big enterprise customer, already paying them $10 million a year. That same customer just signed a new deal for an additional $7 million, just for Firefly and Foundry services. Think about that. That's not a small add-on. That's a 70% increase in the contract value, driven entirely by AI.
Okay, so that's the AI story they're painting. It's a pretty compelling one. But what about the future? Let's dig into their guidance and the big strategic chess moves they're making.
All right, here's their guidance for the next fiscal year. At first glance, it looks fine. Solid growth projected, but, and this is a big but, there's one number that really jumped out to Wall Street. Their ARR growth, annual recurring revenue growth, is guided to about 10.2%. Now, that sounds okay until you remember they just did 11.5%. So they're guiding to a deceleration, a slowdown, and that's a red flag for a lot of investors.
The other big thing they talked about was their massive acquisition of Semrush. We're talking $1.9 billion, all cash. This isn't a small tuck-in. It's a huge bet on where they think the future of online discovery is heading.
So why are they dropping almost $2 billion on Semrush? Well, it's all about this idea they're calling Generative Engine Optimization, or GEO. Forget SEO and just ranking on Google. This is the next level. It's about making sure that when you ask an AI chatbot, hey, what's the best software for X? Your brand is the one that gets recommended. It's a whole new ballgame.
So let's recap. A solid beat, a super bullish story on AI, a big strategic acquisition. I mean, what's not to like? And yet, the stock did nothing. So let's finally tackle the big question: why?
To really get why the market yawned, you have to zoom out and look at the context.
Over the last year, Adobe stock has gotten crushed. It's down 37%. Meanwhile, the S&P 500 is up 15%, and the tech sector is up 25%. So Adobe was already in the doghouse. They came into this report with a whole lot of skeptical investors just waiting to be convinced.
And that's really the heart of the matter, isn't it? The numbers are good, the execution seems fine, but the market just isn't buying the narrative. So, what exactly are these big investor fears?
Okay, it really boils down to a few things. First, there's this big question mark around AI monetization. Yeah, the usage is exploding, but can they turn that into real, durable revenue growth? And that guidance for slowing ARR growth, that poured gasoline on that fire. Second, there's the competition. There's a fear that the big infrastructure players, the NVIDIAs of the world, will soak up all the AI profits, leaving application guys like Adobe with the scraps. And the final piece of the puzzle? Look at the options market. The smart money was betting on a big 7% move, up or down. The fact that the stock just fizzled with a tiny dip, that screams a lack of conviction. The bulls didn't show up to the party.
So, this all begs the question, where does the stock go from here? It really sets up a fascinating bull versus bear debate as we head into the next quarter.
Okay, let's break it down. The bull case is pretty straightforward. Look at those AI metrics. They're inflecting big time. The company is a cash flow monster, and frankly, the stock looks cheap, trading at around 20 times forward earnings. But the bears, they're saying, not so fast. They'll tell you the AI monetization is just a story until it shows up in the numbers. They'll point to that decelerating ARR growth, and they'll argue that this is a classic show-me stock now. It's stuck in the penalty box until the company can prove the AI hype is real.
So, where do we land on this? Our official rating is market perform. Look, the underlying business is solid, but the stock is fighting a perception battle. We think it's probably going to be stuck in a range, basically go sideways, until management can provide undeniable proof that AI is truly re-accelerating that total ARR growth back up into the mid-teens.
But if you're looking for a way to play this, here's an idea. It's a classic pairs trade. You'd go long on Adobe, betting that its cheap valuation and strong fundamentals will eventually win out. But to hedge your bet, you'd go short on another, much more expensive AI software company, one where all the good news is already baked into the price. The thinking here is you're betting on Adobe to close that valuation gap, while protecting yourself in case the whole AI software space hits a snag.
And of course, please remember, this is not financial advice.